So just what exactly is driving the stock market? Is the market going to continue its rise, or are there concerns that investors are going to see the third quarter results come in and then sell stocks? Well, my guests on this issue are Rick Bensignor. He's the chief market strategist at Execution Noble. We also have Dan Wiener. He's the chairman at Advisor Investment Management, joining us from San Francisco. Gentlemen, good to have you with us on Taking Stock. Yeah. Rick Bensignor, so this market just kind of seems to grind ever higher.
Yes, it does.
Why?
Why is it grinding higher?
I know people are buying, but I mean, what's behind the buying?
I think it's really a lack of hedge funds being fully invested and properly positioned for sustained rally. So they keep putting a little bit more on, doesn't pull back where they can get better prices, so they put a little bit more on, and it kind of, the upward price movement keeps the bid in the market.
So does this mean that hedge funds are taking a look at their benchmarks and then thinking, we're going to have to send out those client letters and we're behind the benchmarks. The only way to do that is to get on board?
I think so. I think so. These guys were underinvested for a large portion of the year. Look, September 1st, within a couple of days of there, I was sitting on the show with you, and the S&P was trading 1,050. We're now near 1160, 65, somewhere in that neighborhood. There's a heck of a lot of movement for a 6-week period, and back then it felt like we were on the precipice of the market really coming off. And in fact, we had said we were at the most major inflection point of the year.
I remember inflection,
and that buyers needed to show up if they were going to come. Now was then was the time and place for it to happen. They certainly have in a very decent way.
Dan Wiener, let me come to you because you've made the observation that it seems as though retail investors are doing the exact opposite of what major corporations are doing. Explain that.
That's exactly right. What you're seeing in fund flows is individual investors are selling stocks and they're buying bonds. The flip side is that large U.S. corporations are doing the exact opposite. They're selling bonds. You've seen a lot of large corporations, IBM, for instance, Johnson & Johnson, issuing very low-yielding bonds into this market. They're selling bonds. They're taking on some debt, and at the same time announcing a lot of stock buybacks. We saw, I think, $260 billion worth of announced buybacks in the first 9 months of this year versus about 1/5 that, $50 billion in the first 9 months of 2009. Just today I saw come across the Bloomberg Viacom, $4 billion buyback as well. So the fourth quarter's starting off strong as well.
Rick Bensignor, what do you make of that? Companies selling bonds, buying stock.
Dan's got it perfectly. You've got institutions issuing debt. The public's more than happy to seem to take it. Why? Because it appears to them to be less risky than the risk of being in the stock market, which at this point, most people in the public just don't understand anymore. To have the flash crash occur, to have market movement the way it's been in the last 2 years, let's say, and especially in the last 6 months or so, I think has really taken, you could potentially say, a generation of investors out of the market. If you're a 25 to 30-year-old young person who just recently started a career, I'm not so sure you're likely to be putting money into 401k all the time, because you see and you kind of just live through what this mess has been. You've got a lot of the public missing. So they're going for the safety in the bonds, but they're getting no yield, and they're locking in for 10 years.
All right. Dan Wiener, you're in San Francisco. Do you get the impression that investors on the left coast perceive the market movements any differently than they do here in New York?
No, I haven't gotten that at all, although we do have a few clients out here who've done very nicely for themselves being on the left coast. But there's a lot of mixed messages out in the market right now. I opened one publication the other day, and in the same publication there was an article quoting all about one guy's prediction that for the next 3 weeks the market's going to go down 8%, but then we're going to get a 22% rally through the end of the year. 3 pages later, there's an article about someone who's calling for Dow 38,000 beginning in 2017. A couple weeks ago, somebody was on the web with a prediction of Dow 1,000. No wonder investors are confused and don't really know which way to turn.
So, Dan Wiener, what are you suggesting right now for investors?
Well, we've got our clients pretty well diversified across large cap growth stocks that pay decent dividends that we hope are going to increase those dividends. You've got a nice yield. I mean, when you've got drug stocks and you've got financial stocks and you've got manufacturing stocks all paying yields that are well above a 10-year treasury, and these are strong balance sheet companies, we want to own them. We like growth at a reasonable price, and we get that through some managers on the West Coast, Prime Cap Management. We've got some money in the emerging markets, and we're combining emerging market equities with emerging market debt. So it's sort of the chicken's way into the emerging markets. And, you know, we keep our clients diversified. We own some corporate bonds, short and intermediate term, some Ginnie Maes. We don't want to make too big a bet in any one direction, and we're able to knock off the peaks and valleys in the volatility of the market, which, you know, we're in third quarter earnings season, right? We don't know what's coming up in the next couple weeks.
Rick Bensignor, I'm glad Dan Wiener mentioned this whole idea of third quarter earnings and this idea of maybe grinding higher. The financials, they kick off tomorrow. We got JP Morgan Chase coming out at 7 a.m. with their results. Do the financials have to move up for the market to really get excited?
I don't think so. There have been times in the past where the market can move up without a major sector partaking, like the financials, like technology. And given what's going on, it would not surprise me if the market continues to kind of grind higher, and the financials are not a big part of it. Now, if financials surprise to the upside, which I don't think too many people on the street would anticipate, that could really give some juice to the market, because a lot of people still are really shying away from large cap financial names. If you get the JP Morgans and then later on when Goldman, Morgan Stanley and so come up during earnings season, and it would be a surprise if they beat, but if they do, that really could give some luster to the market. But even if they didn't, I don't think that in and of itself would stop the market from going higher if it wanted to, and it feels in general like it wants to. Wouldn't surprise me if in the next maybe 1 to 3 days we start a pullback that maybe takes us a few percent lower. But to address some of the stuff Dan was talking about, I don't anticipate that the S&P takes out its all-time high from 2007 for several years to come. I also don't anticipate that the lows that we saw in March of 2009 with the S&P about 667 will be taken out either. So if I had to anticipate some type of really large trading range, we're talking 850 to maybe 1400. And I think you kind of want to play that. So here at 1160-ish, we still potentially have some room to go. If we pull back 2 to 4%, I'd want to be buying stocks. I don't think there's a large chance we pull under 1100 right now.
What role does the U.S. dollar play in this? Add that to the whole cocktail.
Well, the dollar's an important thing here. It's been, as I wrote this morning in a note, I said it's kind of been relegated to dishwasher duty. It is currency non grata right now. And it's kind of been that way since April. So we had a little bounce a couple months ago to start the summer, but then after the FOMC statement a month ago, or maybe it was 3 weeks ago, they just trashed the dollar again. I think you have a lot of Wall Street traders who are on the wrong side of that trade. They're stuck long the dollar. They're hoping for a rally, I think, to get out of a bad position. But until you get some type of dollar movement up, I suspect stocks can still keep a bit to it.
Dan Wiener, come in on the topic of international investing, because I know that you follow what happens at Vanguard Mutual Funds. They're introducing a new international real estate investment trust product. Explain why you think that may give a signal as to where investor money is flowing.
Well, investors obviously have gone into REITs. REITs have been very strong this year, and Vanguard is diversifying out by giving people an option to also put money into non-U.S. REITs. My analysis of the historical trading performance of these two indices is that if you combine the two, you can take out some of the highs and lows that you see in that fairly volatile sector from time to time. But, you know, to go to Rick's point about the dollar, if you recall, before the market fell out of bed at the end of 2008, foreign stocks had outperformed U.S. stocks. There was a lot of talk about how the U.S. market was now going to outperform. The dollar has had a very big impact on the way foreign stocks and foreign mutual funds have performed so far this year for U.S. investors. Up until a day or two ago, the leading index was actually a foreign index. Not that the markets were higher, but when you combine the market's performance with the dollar's decline, investors in foreign stocks actually did better than those who were invested domestically.
All right, we're going to have to leave it there. I want to thank you very much, Dan Wiener, joining us from San Francisco. Rick Bensignor from Execution Noble. Coming